Hello, welcome to the Sulphur webinar from Fertecon. I'm Yuya, taking charge of a long-term Sulphur outlook. Today, we're going to discuss some key market trends which will shape the Sulphur market through the rest of this year and over the next 5 years. In this webinar, I will briefly introduce our Sulphur team and the reports we provided. Then I will pass to my colleague Maria. She will give you a brief overview of the current Sulphur market and discuss a key issue of the major importers. At the end, I will discuss the key exporting countries, share our views on long-term Sulphur supply and demand, as well as the key trade trends. 5 co-analysts in Fertecon Sulphur team. Maria Mosquera, another presenter in this webinar, is responsible for the current market information. She is the editor of Sulphur Weekly and Sulphuric Acid Weekly. Sarah Marlowe is the head of the current market information team and is the editor of Sulphur Futures. She has more than 20 years experiences. Alan Pickett has more than 35 years experiences in the fertilizer industry. He takes care of our consulting services. Isaac Zhao is our Chinese market expert who has been in this industry for 14 years. As introduced previously, I'm Yuya, taking charge of a long-term market analysis. In Fertecon Sulphur portfolio, we have 2 weekly reports, Sulphur and Sulphuric Acid, 1 monthly report, and a Sulphur long-term outlook, which is published each quarter. This report provides long-term forecast of a supply-demand trade balance and prices, as well as a free cost model. We have recently joined IHS Markit and its family of intelligence and analysis-based teams and services. When nothing is changing for now, we're excited about the possibilities for our customers, products, and teams in the future. This couple of slides will show IHS Markit strengths and the chemical portfolio.
I will now take a brief look at the key trends in the current sulfur and sulfuric acid markets. The weakening of the Chinese market to below $100 CFR as a result of the inventory levels hitting 2.2 million tons has resulted in negative margins for traders. The discrepancy between Middle East monthly and quarterly pricing, with traders indicating agreements at $95 to $100 FOB for Q3 allocations, and the additional complication of the increased freight and shipping costs due to an escalation in tensions in the Middle East have caused a disconnect between selling prices and delivered prices. This has led to losses incurred by cargo holders on end-user business. The main Middle East suppliers set July contract pricing in a range of $98 to $100 FOB Middle East. However, with the increased level of freight and shipping costs, selling prices in this range would result in delivered pricing in the upper 110s CFR China, $20 above pricing acceptable to buyers. This has now been corrected with the publication of August pricing from the Middle East, with Montajat announcing $75 FOB Ras Laffan for QSP in August, allowing again for workable margins. Weak demand from Chinese end users due to low demand for phosphates having reduced operating rates has resulted in the substantial inventory levels at ports. July inventory levels stood at around 770,000 tons above the level the previous year, while operating rates are lower this year, with end users largely operating at around 80% in Q3 last year, as opposed to the planned 60% this year. The commencement of the domestic season in September is expected to prompt a pickup in demand levels, but the backlog accrued in the meantime will take some time to liquidate. In Morocco, OCP is understood to have agreed a level of $80 to $98 CFR for Q3 supply with all suppliers. The delivered pricing is unchanged on Q2, but due to increased shipping costs, a reduction of around $4 is understood to have been agreed from the Middle East on FOB basis for Q3. Freight rates from the Black Sea have also recently seen some increases due to the beginning of the grain season, and as such further competition for bulk vessels will have also been factored into the delivered pricing range. The stable level on Q3 supply despite the weakening market took much of the market by surprise and proved a supporting factor for Middle East for pricing. In Europe, the Q3 supply for molten sulfur concluded at a rollover, with the ongoing tight supply situation supporting pricing despite the general drop in the global granular market. Several factors such as refinery outages, sweeter feedstocks and crude oil supply disruptions have contributed to this, and I will discuss these in more detail in a minute. Globally, during Q4 2018, it was evident the price of sulfuric acid had separated from that of sulfur, with sulfur prices weakening and sulfuric acid remaining at a firm level. It is now clear the correction has taken place over the first half of 2019. While sulfur pricing has continued to soften, sulfuric acid pricing has come down steeply over the first half of 2019, with the gap increasing between the two. Some stability has now been reported for sulfuric acid pricing, supported by maintenance rounds reducing supply and Chinese suppliers pulling back due to reduced export margins. But a downward risk factor is the continued weakness of the sulfur price going forward. The downstream phosphate fertilizer demand remains subdued, suggesting little incentive for any significant upward movement for the price of sulfur. In the sulfuric acid market in China, the reduction in Chinese export volumes seen recently following the steep drop in margins has now contributed to the stabilization of market pricing. A few export shipments have been spotted from Putian Port and Fangcheng recently, as well as the regular Two Lions contract cargoes for OCP at Jorflas-Far, but for the large part, Chinese smelters are now understood to be focusing on the local domestic market. This in turn, coupled with the several turnarounds scheduled in the Far East over July and September, has reduced the pressure on exporters in Japan and South Korea and allowed pricing to stabilize. In Morocco, the new sulfuric acid plant at Jorflas-Far is currently undergoing commissioning stages, with production having commenced in July. The production capacity of the new plant is 4,200 tons sulfuric acid per day. In addition, the two additional sulfuric acid plants coming up between 2020 and 2021, also at the site of Jorflas-Far, will each have a production capacity of 5,000 tons sulfuric acid per day. When the current plant under commissioning now is fully operational, the overall sulfuric acid production capacity at Jorflas-Far will stand at 6.25 million tons per year, and by 2021 the overall sulfuric acid production capacity is expected to reach a substantial 9 to 10 million tons per year. In Europe, the tightness of molten sulfur in the region has also had a knock-on impact on sulfur burner acid availability, and while smelter acid availability is deemed as good, for those requiring higher grade acid the situation remains tight. Some tightness is expected to remain throughout Q3, though the situation should begin to ease as molten sulfur supply recovers during the quarter. The summer months tend to see lower production levels in the region and a slowdown in business due to a combination of the summer holiday period and hot weather. Next, we will take a look at developments in some of the key markets. Taking a closer look at European sulfur trade flows, the main importers of molten product in the region are Belgium, the Netherlands, France and Germany. Meanwhile, Lithuania, Poland and Slovenia can handle granular product as well as molten product. The main exporters for molten sulfur in the region are Germany, the Netherlands and Sweden, though German supply in particular will decline over the coming 10 years as its gas fields are dwindling and supply will gradually reduce. Due to many of the countries only engaging in the molten sulfur market, it operates in a somewhat separate bubble to the global granular market and has recently seen firmer pricing in comparison to the weaker global situation due to a structural tightness and some additional factors over the first half of 2019. There are several factors tightening supply of molten product in Europe, of which crude oil import sources are a significant one. Due to the insular nature of the market and the region's limited remelting capacity, refinery outages such as those seen recently in Germany and France have had an impact on the supply-demand balance in the first 6 months of 2019. Additionally, a concentration of maintenance rounds in the region during the first half of 2019 to enable refineries to sell distillates in the second half of the year at better expected margins due to the approaching IMO 2020 regulations has contributed to tightness. Most refineries are also consistently using sweeter product as feedstock, further tightening the supply of recovered sulfur. At present, not only is the price differential favoring sweeter US product, but a lack of sour product due to the recent sanctions on important producers of sour crude, such as Iran and Venezuela, is also a significant consideration. Since April, an additional issue has been the contamination of Russian crude oil through the Druzhba pipeline into several European refineries that persisted for over 2 months and is expected to fully recover only during August. According to some estimates, 8% of Europe's oil refinery feedstock was affected, and some speculate that refineries that have turned to alternative supplies, such as US Gulf product, may continue to diversify for secure continued supply. This has tightened the market further and may continue to do so. The new molten sulfur terminal located in Antwerp is expected to be finished by the end of 2019 and become operational by the beginning of 2020, with associated sulfur forming facility attached. It will serve producers of molten sulfur in the region and provide an export facility in times of oversupply. This facility will also serve as a mechanism to support pricing in the region, and is set to replace the existing terminal in Brake, as molten sulfur supply from Germany becomes increasingly limited due to the depletion of the gas fields in the coming years. The Brake terminal is now planned to be transformed into an import terminal, with existing deep-sea port facility able to accommodate large bulk carriers similar to Antwerp. This will become an import terminal for granular sulfur with a remelting facility for 200,000 tons, plus storage designed for commercial use, and is expected to provide flexibility for buyers of molten sulfur and a mechanism for capping pricing in times of tightness. At the moment, no such facility exists, and avenues available for buyers during a lack of availability in the region include importing molten product from the US Gulf at a premium, an avenue that was utilized in Q2 as a buyer sought to secure supply, or possibly railing in molten product from Poland. There are existing remelters in Europe, but these are all designed to secure supply for their operating companies and not regularly used commercially. The Bilbao, Bayonne and the Helsingborg remelters have operating rates much below capacity due to the cost of remelting standing at above local supply, where it is readily available and secured under contracts. However, due to a combination of factors, the supply of molten product in the region is becoming chronically tight. As such, any additional issues such as unplanned maintenance or crude supply bottlenecks create a further supply shortage, and also impact on the availability of sulphuric acid of certain grades from sulfur burners in the region. In the European region there are 2 liquid sulfur vessels, one of which is the Sulphur Genesis operated by a Globis that was acquired by Mitsui in 2017. The Sulphur Genesis makes regular trips from Antwerp, Rotterdam and Skoldvik to Helsingborg and has remained in the region so far in 2019. The second liquid sulfur vessel in the region was commissioned in early April 2018 and is being operated by Total. This gives Total the flexibility to export product out of the region to support local pricing, and in 2018 Morocco received in excess of 22,000 tons of molten sulfur from France in small shipments on board the Ivory Ability. So far, no out-of-region trips have been made by the Ivory Ability in 2019, as there has been additional tightness in the region and disruptions reported at some of Total's refineries. In fact, in Q2 2019, the tightness in Europe was at such a level that the Ivory Ability called Galveston on the 8th of March and loaded a cargo from the US Gulf bound for Kemira in Helsingborg. Such a spot deal would command premium pricing due to the distance. Looking at the largest sulfur importer in the world, China, exceptionally high port inventory levels have built up over Q2, when a significant quantity of trader volumes arrived at Chinese ports. Such high levels have been reached due to low end-user demand borne out of the low operating rates of phosphate fertilizer producers, with the downstream market providing poor margins on business. In July, the 2 million ton stock level was broken and a level of 2.2 million tons was reached, and CFR business halted, with buyers unwilling to pay the premium pricing payable for Middle East volumes, with port stock so readily and abundantly available. As storage capacity limits were reached late in July, at some ports, pricing dipped as some volumes were finally liquidated. Downside risks on further CFR business remains, with pricing having dipped from a high of 118 CFR to 100 CFR during July, with DAP producers in China indicating cuts of 40% on operating rates, possibly amounting up to 1.8 to 2 million tons over the second half of 2019, as DAP and MAP producers have lost any margin with finished fertilizer prices weakening, while raw material costs have remained high in comparison. These producers now need to see reductions in sulfur pricing to continue producing, with the phosphate fertilizer market oversupplied and demand weak. The liquidation of held port volumes will take some time, and as such, the recovery of pricing will likely show a delay following the picking up of downstream demand expected when the domestic season kicks in from September. The Fertecon team went on a site visit to Sulphur in July, and we got a chance to see the projects coming up on site and the various plants running in the complex, including the port facilities at Sulphur. Conversations with technical personnel and seeing the operations firsthand served to deepen our understanding of the flexibility of strategy of options in the upstream and downstream markets. Import volumes into Morocco have continued to increase, and additional capacity is likely to lift consumption in the coming few years, with, in addition to the new sulphuric acid plant ramping up currently, 2 more are due to be commissioned by 2021 on the site of Sulphur. Overall capacity is constantly increasing due to expansions, but operating rates can be tailored to strategy, and the health of the phosphate market will have an impact on this, as will other considerations. Options to vary operating rates between specialty fertilizers, DAP and MAP, as well as phosphoric acid, as was done in Q1 for P2O5 exports to India in favor of DAP production, also factor in depending on the economics between the various products at any given time. Moroccan imports from Russian origin were at their lowest in proportion to overall imports in 2018. Supply disruptions via Kavkaz under usual contract arrangements impacted on import levels from Russia, and a subsequent supply agreement between OCP and ADNOC was agreed. UAE imports account for a large share into Morocco, though now uncertainty in the AG as tensions build is becoming a consideration. Vessel movements through the Strait of Hormuz are under risk as Iranian retaliation on US sanctions threatens vessel traffic. This has had a knock-on impact on freight rates from the Middle East, and while Q3 2019 contracts largely rolled over on CFR basis, due to the increases in freights, a drop of around $4 on FOB basis was seen going from Q2 into Q3. A large volume estimated at around 500,000 tons of both crushed and granular product was booked for Q3 from the FSU, and if insecurity in the Middle East persists, this could potentially see a shift back to increased Russian volumes, provided that Russian supply remains reliable. Secure supply despite political factors is an important consideration and expected to impact on strategy decisions around import sources going forward. Thank you. I will now hand over to my colleague Yuya, who will discuss a few of the major suppliers and some of the long-term trends.
Thanks, Maria. Now let's look at the major exporters. Booming Saudi gas project in the Middle East has led to a significant increase in elemental sulfur supply in the global trade market over the last few years. The UAE and Saudi are the 2 largest exporters in the global market now. The UAE has seen elemental sulfur exports increased by more than 20% over the last 5 years. The major producers ADNOC in this country is by far the largest supplier to Morocco on the backup of a long-term agreement signed by 2 parties. Among the top 10 exporters, 4 of them are located in the Middle East. Iran is the major exporter in China. The US sanctions has not made any dramatic impact on Iranian shipments to China yet. Moving to the next slide, I'll give you a brief overview of the key projects in the Middle East which have just come on stream or expected to come on stream within the next few years. In Iran, the 4 phases of the complex South Pass gas project were officially inaugurated on 17 March 2019. Upon completion of these 4 phases, total sulfur capacity reached 1.75 million tons per year, making South Pass one of the largest sulfur production hubs in the world. In Qatar, Qatar Gas Basin gas project has suffered from long delays due to major pipeline repairs. This project is now expected to be completed by the end of this year, but the exact date has not been confirmed yet. Expansions at the Petro-Ruby refinery as well as the Fahili gas project will bring additional sulfur output at the end of this year in Saudi. Aramco's Jazan refinery has been delayed further. It is now expected to see first commercial production at the beginning of 2020. Additional sulfur supply in the UAE will mainly come from continuous expansions at the Shah and Habshan gas field. Startup of the Azul refinery in Kuwait is now scheduled in 2020. Russia was the 5th largest exporter in the world. In 2018, there was lack of Russian tonnage in Black Sea market. With a lack of Black Sea tons, Africa trade route was partly taken by Kazakhstan. This was due to strong domestic demand in Russia, logistic constraints, and the long-term supply agreement between ADNOC and OCP. The significant amounts of additional Russian materials are available in the Black Sea market this year. However, it will be challenging to place such a quantities of crushed lump in the market, with only OCP currently taking lump product on a large scale. Sulfur exports from Russia are set to increase, but to what extent? Detailed analysis is covered in the outlook. In North America, the US and Canada are also among the top 10 exporters in the global sulfur trade market. The major issue surrounding Canada is the high level of inventory. Despite Alberta's cutback in oil production for 2019, total sulfur production is expected to increase due to high oil sands production. The increase in oil sand-based sulfur production will offset the decrease in gas-based sulfur production in Canada. Total element sulfur will continue to increase a bit at a lower rate. Canada's sulfur stockpiles have been under upward pressure since mid-2015, as sulfur prices have come down, making it harder to achieve positive margins for Canadian exporters. These then came under further pressure as the Mosaic's rematter come on stream. Higher sulfur production, along with weaker sulfur prices, will continue to place upward pressure on Canada's stockpiles. In the United States, the Gulf Coast region is a major production hub for the country's sulfur supply. This region accounts for 60% of the nation's total sulfur production. According to the EIA report, the density of crude oil processed by the U.S. Gulf Coast refineries has become lighter since 2008, as Gulf refineries are investing to upgrade their facilities to process light crude from the Permian and other U.S. shale players. These investment activities are encouraged by tight availability of sour crude these days due to the geopolitical tensions. This has negatively impacted sulfur supply in the U.S. In the next few slides, I will share our views on the global sulfur supply and demand trend over the next 5 years. As discussed previously, the Middle East is a leading factor for the growth of the global element sulfur supply. This region accounts for more than 30% of global sulfur supply. Middle East will continue to lead the growth trend, bringing total element sulfur production to a level above 76 million tons per year by 2025. In this slide, I will summarize the key points to watch in the major supply regions over the next few years. In North America, the key issues surround the availability of sour crude in Gulf Coast and increasing share of shale oil. In Canada, the key question being asked is whether the increase in oil sand production will offset the decrease due to the depleting gas reserves. Europe's liquid sulfur supply has remained tight over the last couple of years due to a number of unexpected disruptions and tight availability of sour crude. Will this tight supply persist? Gazprom in Russia is the largest gas producer and also one of the largest sulfur producers in the world. It has ambitious plans to expand capacity aimed at increasing demand for natural gas in Europe and Asia market. This cannot be fully translated into strong sulfur supply growth, as not all the gas reserves in Russia are sour-based. In Central Asia, logistic constraints will remain a concern. Ranked the fourth in terms of proving natural gas reserves, Turkmenistan has a great potential to boost its gas production to supply booming gas market in Europe and Asia. However, additional sulfur output in Turkmenistan may be stranded in the country due to high inland freight rates. Unlike Kazakhstan, there is no preferential rail rate for Turkmen sulfur through Russia, which limits seaborne access to the Iranian ports in Persian Gulf. In the longer term, this issue may be resolved either through more cost-effective routes out through Kazakhstan and Russia or through Iran, but at present there are no straightforward routes to access ocean trade routes. Boost for sour gas in the Middle East, along with the refining expansion in Asia and the Middle East, have led to a strong increase in sulfur supply over the last few years. The strong wave of investment may end in the early 2020s, which will ease the supply growth pressure. All these issues will play a role in determining global sulfur supply over the next 5 years. Phosphate is the largest end-use sector for sulfur in all forms demand. So on the demand side, the key issue surrounds how healthy the phosphate market would be. The phosphate market has remained sluggish year-to-date in 2019. The key question being asked is when will this sector recover? Development of lithium battery and electric vehicles will bring an upbeat outlook of non-ferrous metals including copper, nickel, and cobalt. However, this cannot be directly translated into strong investment in lithium facilities. Such as in China, strong demand for copper could result in more smelt acid production rather than leach-based sulfur demand. Ammonium sulfate has a great growth potential due to lightweighting trend on the auto industry, which will support demand for caprolactam. Demand in the industry sectors will be tempered by a more moderate global outlook in key consuming industries, especially over the next 5 years. Moving to the next slide, there are 5 major phosphate production hubs in the world: the US, Brazil, Morocco, Russia, and China. Sulfur demand in these 5 countries will be subject to the health of the phosphate market and the competitiveness of the major producers in the international trade markets. Latin America and Africa are 2 major production hubs for non-ferrous metals. Upbeat outlook for non-ferrous metals could support demand for sulfur, but the growth pace will depend on the investment in lithium facilities. If growth of smelt acid outpaces the demand for leach-based sulfur, there will be very small or even no increase in demand for elemental sulfur. Now let's look at the global sulfur trade trends. This slide shows the major route of sulfur trade flows in 2018. This slide summarizes the key trends in the global trade market. From the exporter's perspective, the key trend will include new sulfur capacity from the Middle East will bring additional sulfur supply in the global trade market. This will result in intensified competition in the trade market, weigh on sulfur prices. Russian volumes is expected to recover in 2019. We have seen additional availabilities in the Black Sea market, but how much of the additional Russian tonnage can make their way to the market? Although Central Asia has great growth potential for sulfur supply, Logistic constraints will remain concerns. High logistic costs could squeeze Canadian exporters' margin in Asia-Pacific market. This, along with higher sulphur output, will place upward pressure on Canadian stockpiling. Additional domestic sulphur resources will result in lower import requirements in China. Morocco's imports were supported by OCP's capacity expansion. This is also subject to how competitive OCP would be in the global phosphate market. Brazilian sulphur imports reached a record high in 2018. Our analysts suggested that at least half of the increase in Brazilian imports in 2018 was for stockpiling in preparation for the anticipated downstream expansions. Destocking, delay of the downstream expansion project, along with suspension of Mosaic's rock mines, will weigh on Brazil's sulphur import requirements in 2019. In conclusion, supply growth will continue to outpace demand growth through the middle 2020s. Boost for sour gas and refining expansions will lead to more intensified competition. Additional domestic supply will impact China's import requirements. OCP will see higher sulphur requirements, but its focus on internal rebalancing of raw materials will lead to more market uncertainties. Limited availability of sour crude has tightened sulphur supply in the US and many European countries. This may persist over the next couple of years due to the geopolitical tensions. Logistic constraints and high freight costs could make more sulphur stranded in certain regions. Over the long term, tight environmental regulations, energy revolutions, along with the development of the battery metals and electric vehicles, will play more important roles in sulphur market. Fertecon has more than 40 years expertise in the fertilizer industry. We provide a wide range of weekly reports, short-term future reports, long-term outlook, as well as consultancy services across the value chain. If you want to know more about our services, please contact our marketing team. If you would like to discuss the market, please feel free to reach our analyst. Thanks for listening.